Maximizing personal finances, the role of standard tax deductions. Taxation is an inevitable facet of our financial lives, and understanding its nuances can significantly impact personal finances. One crucial element in navigating the tax landscape is the concept of standard deductions. Standard deductions are fixed amounts that reduce the income subject to tax, providing taxpayers with a simplified method for reducing their tax liability. At its core, the standard deduction is a tool to alleviate the tax burden on individuals and families. Allowing taxpayers to subtract a predetermined amount from their taxable income ensures they retain a portion of their earnings to meet their financial needs. This deduction serves as a cornerstone in personal finance strategies, offering a straightforward means to optimize tax obligations. One of the primary advantages of standard deductions is their simplicity. Unlike itemized deductions, which require meticulous record-keeping and documentation of mortgage interest, medical expenses, and charitable contributions, standard deductions offer a streamlined alternative. This simplicity saves taxpayers time and effort and reduces the likelihood of errors in tax filings. Furthermore, standard deductions promote fairness and equity in the tax system. Standard deductions ensure that lower-income individuals receive proportionally greater tax relief by providing a uniform deduction amount to all taxpayers regardless of their circumstances. This progressive feature helps alleviate the tax burden on those who may be financially disadvantaged, thereby fostering social and economic equity. Standard deductions also play a pivotal role in financial planning and decision-making. Understanding the implications of standard deductions allows individuals to make informed choices regarding their financial affairs. Whether it involves retirement planning, investment decisions, or major purchases, factoring in the tax implications of standard deductions enables individuals to optimize their financial outcomes. However, standard deductions may only sometimes be the most advantageous option for every taxpayer. Depending on their specific financial situation, some individuals may benefit more from itemizing deductions, particularly if they have significant deductible expenses such as mortgage interest or medical costs. Thus, taxpayers must carefully assess their circumstances and explore standard and itemized deduction options to determine the most beneficial approach. Maximizing financial well-being, the role of tax exclusions in personal finance. Tax exclusions are pivotal in personal finance, influencing individuals' financial decisions and shaping their financial health. These exclusions, offered by governments as incentives or benefits, allow taxpayers to exclude certain types of income or expenses from their taxable income, ultimately affecting their tax liability. Understanding these exclusions is crucial for individuals seeking to optimize their financial well-being. One of the most common tax exclusions is excluding certain types of income from taxation, such as income from municipal bonds or retirement accounts like Roth IRAs. By excluding this income from taxation, individuals can maximize their investment returns and accumulate wealth more efficiently. For example, investing in municipal bonds allows taxpayers to earn interest income exempt from federal income tax, providing a higher after-tax return than taxable investments. Moreover, tax exclusions are also available for specific expenses, such as health savings accounts, HSAs, or certain educational expenses. Contributions to HSAs are tax-deductible, and withdrawals used for qualified medical expenses are tax-free, providing individuals with a powerful tool to save for healthcare costs while reducing their tax burden. Similarly, tax exclusions for educational expenses, such as the American Opportunity Tax Credit or the Lifetime Learning Credit, help individuals afford higher education and improve their earning potential without incurring additional tax liabilities. Furthermore, tax exclusions can also promote certain behaviors deemed beneficial for society. For instance, excluding employer-sponsored health insurance premiums from taxable income encourages employers to provide their employees health insurance benefits, promoting healthcare access. Similarly, tax exclusions for contributions to retirement accounts incentivize individuals to save for retirement, reducing their reliance on government assistance programs in their later years. However, while tax exclusions offer numerous advantages, they also have limitations and complexities that individuals must navigate. Understanding eligibility criteria, contribution limits, and withdrawal rules is essential to maximize the benefits of tax exclusions while avoiding penalties and unintended tax consequences. Quarterly tax payments, a vital element in personal finance. In personal finance, few obligations are as significant, yet often overlooked, as quarterly tax payments. For many individuals, the mere mention of taxes evokes a sense of dread or confusion. However, understanding and managing quarterly tax payments is essential for staying compliant with the law, maintaining financial stability, and planning effectively for the future. First and foremost, quarterly tax payments are a legal requirement for those who earn income that is not subject to withholding taxes, such as self-employed individuals, freelancers, and small business owners. By making these payments quarterly, taxpayers ensure they meet their tax obligations throughout the year, rather than facing a large, potentially overwhelming tax bill come April. Moreover, keeping quarterly tax payments is integral to maintaining financial stability. By budgeting for these payments and setting aside funds regularly, individuals can avoid the stress and financial strain of generating a large sum of money simultaneously. This proactive approach to tax management prevents unnecessary anxiety and promotes disciplined financial habits, laying the groundwork for long-term financial success. Furthermore, quarterly tax payments play a crucial role in effective financial planning. By estimating their income and tax liability for the year ahead, taxpayers can adjust their quarterly payments accordingly, considering changes in income, deductions, and credits. This proactive approach allows individuals to optimize their tax situation, potentially minimizing their tax liability and maximizing their financial resources. Additionally, timely and accurate quarterly tax payments can help individuals avoid penalties and interest charges imposed by the IRS for underpayment or late payment of taxes. By staying compliant with tax regulations and fulfilling their obligations promptly, taxpayers can avoid unnecessary financial setbacks and maintain their financial health. Optimizing tax strategies, choosing the right filing status for personal finance success. Tax filing status is a critical aspect of personal finance, as it determines how much tax an individual owes to the government and affects their overall financial situation. Understanding the different filing statuses and choosing the most advantageous one can significantly impact tax liability and financial well-being. There are 5 main tax filing statuses in the United States: single, married filing jointly, married filing separately, head of household, and qualifying widows with dependent children. Each status has its own set of rules, requirements, and tax implications. Single status applies to individuals who are not married or are legally separated from their spouse by divorce or separate maintenance decree by the last day of the tax year. Single filers often have fewer tax benefits than married filers, but may qualify for certain deductions and credits available to individuals. Married filing jointly status is available to married couples who combine their incomes and file a joint tax return. This status typically offers the most tax advantages, including lower tax rates, higher income thresholds for certain deductions and credits, and eligibility for various tax breaks. Married filing separately status allows married individuals to file separate tax returns while still legally married. However, this status often results in a higher tax liability than filing jointly, as certain tax benefits are unavailable and tax rates may be less favorable. Head of household status is for unmarried individuals who provide a home for a qualifying dependent, such as a child or relative. This filing status offers lower tax rates and a higher standard deduction than filing as single, making it a beneficial option for single parents or individuals caring for dependents. Qualifying widower with dependent child status is available for widows or widowers who meet specific criteria, including having a dependent child and meeting certain income requirements. This filing status allows surviving spouses to continue benefiting from the tax advantages they enjoyed while married for a limited time after the death of their spouse. Understanding the estate tax, necessity, controversy, and implications. The estate tax, or the inheritance tax, or death tax, is one of modern society's most debated fiscal policies. It is a levy imposed on transferring a deceased person's estate to their heirs. The primary objective of this tax is to generate revenue for the government and address economic inequality by redistributing wealth. However, its implementation and implications have sparked debate among policymakers, economists, and the general public. Proponents argue that the estate tax fosters social equity and curbs intergenerational wealth concentration. Imposing a tax on large inheritances prevents the perpetuation of dynastic wealth and promotes meritocracy. Furthermore, revenue generated from the estate tax can fund essential public services and social welfare programs, thus benefiting society. On the other hand, critics raise various concerns regarding the estate tax's effectiveness and fairness. One common argument is that it punishes success and undermines individuals' incentives to accumulate wealth, invest, and engage in entrepreneurial activities. Moreover, opponents contend that the estate tax can be burdensome for family-owned businesses and farms, potentially leading to their liquidation to cover tax liabilities. The threshold at which the estate tax applies and the tax rate are significant points of contention. Advocates for a higher estate tax threshold argue that it should only target the wealthiest individuals, sparing middle-class families from its reach. Conversely, proponents of a lower threshold argue that a broader tax base ensures more excellent revenue collection and a more equitable distribution of the tax burden. The estate tax's impact extends beyond mere fiscal implications. It reflects societal values and priorities, shaping the economic landscape and influencing wealth distribution patterns. Its existence prompts individuals to engage in estate planning strategies to minimize tax liabilities, thereby influencing intergenerational wealth transfer dynamics. Understanding excise tax, its impact and significance. Excise tax, a levy imposed by governments on specific goods and services, serves a multifaceted role in shaping economic behaviors, regulating industries, and generating revenue. Its application spans various sectors, from alcohol and tobacco to fuel and luxury goods, and it plays a pivotal role in fiscal policy. Excise tax is primarily serve as a tool for governments to discourage the consumption of certain goods deemed harmful or non-essential while raising revenue. For instance, excise taxes on tobacco and alcohol aim to reduce the societal costs associated with health issues stemming from excessive consumption. By increasing the price of these products through taxation, consumers are incentivized to moderate their consumption, leading to potential improvements in public health outcomes. Moreover, excise taxes influence consumer behavior and purchasing decisions. The elasticity of demand for taxed goods determines how consumers adjust their consumption patterns in response to price changes. Inelastic goods like gasoline often see limited reductions in demand despite tax increases, as they are necessities for many individuals. Conversely, elastic goods such as cigarettes may experience more significant in consumption as consumers seek alternatives or quit altogether in response to higher prices. In addition to shaping consumer behavior, excise taxes impact industry dynamics and market competitiveness. Industries subject to excise taxes often face unique challenges, including smuggling, counterfeiting, and regulatory compliance costs. These challenges can alter market structures, drive innovation, and influence pricing strategies within affected industries. Moreover, excise taxes may create opportunities for black markets to thrive, especially when there are significant price differentials between legal and illicit products. Furthermore, excise taxes contribute significantly to government revenues, funding essential public services and programs. The allocation of excise tax revenues varies across jurisdictions, with some earmarked for specific purposes such as healthcare, education, or infrastructure development. Consequently, policymakers must balance revenue generation, economic efficiency, and social welfare considerations when designing and implementing excise tax policies. A comparative analysis of investment vehicles, stocks, bonds, and real estate investing is a crucial aspect of financial planning, offering wealth accumulation and growth avenues. Various investment options exist, each with distinct characteristics, risks, and rewards. Among the most common types are stocks, bonds, and real estate. Stocks represent ownership in a company and are traded on stock exchanges. They offer the potential for high returns, often outperforming other investments over the long term. However, they also carry significant volatility and risk. Stock prices fluctuate wildly due to market sentiment, economic conditions, or company performance. Investors may risk losing their entire investment if a company fails or the market experiences a downturn. Nevertheless, diversification across different stocks can mitigate some of these risks. Bonds, on the other hand, are debt securities issued by governments or corporations. When investors buy a bond, they are lending money to the issuer in exchange for periodic interest payments and the return of the principal amount at maturity. Bonds are generally considered safer than stocks because they provide regular income and have a fixed maturity date. However, they may still carry risks like interest rates and credit risks. If interest rates rise, the value of existing bonds may decline, and if the issuer defaults, investors may lose some or all of their investment. Real estate investment involves purchasing properties expected to generate rental income or capital appreciation. Real estate offers the potential for steady cash flow, tax benefits, and diversification from traditional financial assets. However, it also requires significant capital investment and ongoing maintenance costs, and may need to be more liquid, meaning it can be challenging to sell quickly if needed. Additionally, economic conditions, local factors, and regulatory changes can affect real estate markets, leading to fluctuations in property values.